Hi, welcome to Diaries. I'm Tia, this is Michelle, and on our channel we share stories about how to build wealth through real estate. So be sure to subscribe so you can hear more stories from real investors working on real deals.
And our topic for this episode is 5 benefits from buying in a shifting market. Number 1, more negotiation power for buyers. The great thing about buying in a shifting market is that as a buyer, you have a lot more negotiation power when it comes to finding deals and going under contract on a property now. One of the benefits you can get is interest rate buy downs. So I know a lot of people out there are kind of worried about the rising interest rates. But now in this environment that has cooled down a little bit, this is an appropriate time to actually ask the seller, hey, Mr. Seller, Mr. and Mrs. Seller, can you give me a credit to help me buy down the rate? You know, this wouldn't fly if it was last year. But now sellers are a lot more open to offering those kinds of credits. And so those credits can then be now paid as points up front to reduce that rate. So if your interest rate is 7.1%, you may be able to buy it down in the mid 6s or even lower, depending on, how much points you can pay up front. So there's definitely interest rate buy downs. Another benefit that you have as well too is also a lot more negotiation on repairs. And so now sellers are more willing to make repairs or offer more credits for things that need to be repaired at the property. So you can negotiate this as far as further price reductions or credits or money that you can use to help repair stuff. And then of course, you will benefit from reduced pricing. We are seeing some price reductions in a shifted market. So it's a great benefit and more negotiation power when it comes to the buyer.
So number 2 is going to be less competition among buyers. And there's a few ways that you'll know that the market might be shifting a bit. And that's, as Michelle said, price reductions. You may see more inventory on the market. And so in this case, as a buyer, you really want to take advantage because you're going to have less bidding wars. So you may have the opportunity to get that property that you really want, that really fits your needs. And you'll see more properties going under contract and then kind of falling out of contract and coming back to the market. And those are really good properties to potentially take a closer look at and see if that might be something that fits your needs so you can get a good deal.
Number 3, longer contract periods. Another benefit in buying in a shifting market is that you can have a much longer contract period when you're purchasing a property. So in hot sellers markets, a lot of times buyers are pressured to close on a property quickly. So whether that's a week, 2 weeks, or a month, or whatever the case is. The good thing is that now that it's shifting a little bit towards buyers, you do have more time to do your research, do your due diligence. So if you're looking at a commercial building that normally takes 60 days to close, you're like, Mr. Seller, I'd actually need 90 days to close. Or if you're looking at a house that you would normally need to close in 3 weeks to compete in a hot market, you can definitely take your time and do a month or even 45 days. And so whatever information that you need to look into or research, you have that time. You can take your time doing inspections. You can take your time looking at the loan, shopping around for loans and different things like that. Or if you need to raise money, if you need to find partners on a deal, you have that time now because sellers are being a little bit more lenient on giving buyers more time and longer contract periods to help you get the deal.
And to piggyback a little bit off of that, number 4 is that you have more contingencies. And what this means for the buyer is basically, like Michelle said, you have more time to do your due diligence. So before, when it's a seller's market, sometimes you're out there and you're just offering cash. You've got, 2-week close. You don't really have a lot of time. You may even waive the inspection. So you don't have a lot of time to really dig in and see what you're getting. But with the contingencies, you have your appraisal contingency, your inspection contingency, and one of the most important contingencies is contingency to sell another property. And what this means is for those of you that either have a house or, an investment property that you need to sell and you're doing a 1031 exchange, you can put in there that you buying your new property is contingent upon selling the old property. And that's a fantastic win-win. You don't have to go out there into a 1031 exchange kind of not knowing what you're going to purchase. Now you can be ahead of that and basically pick out a property that you'd like to identify for that 1031 exchange and move forward in it while you're selling your old property. So that's a fantastic advantage in a shifting market.
Agreed. And in number 5, the opportunity to gain equity faster as the market bounces back. So as investors, we all know that you should buy low and sell high, right? But the reality is that most people don't, right? Because there's a lot of uncertainty, there's a lot of emotions that kind of go on, or maybe you're just not in the right opportunity to seize new opportunities in a market shift. But the great thing is that if you are in a good place to be able to purchase something, if you buy something at a lower price, right? Especially if you buy even a value add property, meaning like a fixer upper or something like that. So once you purchase something at a certain lower price and fix it up, you do get that forced equity that you will get from just putting the value in, fixing up the property, increasing rents. But as that market shifts up, not only can you benefit from the forced equity you put in it by the improvements you put in, you will also ride the wave of the market as the market comes up again. So it's definitely a better way to gain equity faster when you're buying in a lower shifted market.
For sure. And as we've seen in the past, a lot of people that took advantage of that, like you said, buying low, buying when people weren't out in the market, they are some of the wealthiest people today.
Exactly.
So they got out there and they took the risk and they got the reward.
Absolutely.
So another story for the Door Diaries. Right now in our current local market, we are seeing a market shift. So we're seeing some price reductions, we're seeing more inventory on the market. And one of the newer investors that I'm working with has decided to take that risk and get out there and get in the market. And they've actually been rewarded for it already. Basically, they were able to get a new roof. They were able to get a concession that paid for their down payment. They were able to walk away from the closing table with their earnest money back in their hand. And this is because right now, one, it's a slower time of year for buyers. There's not very many buyers in the market because of the interest rate. And now they've been able to secure their first investment. Whereas if this had been months ago, I mean, it
probably wouldn't be the scenario.
It would not be the scenario.
Yeah.
So I'm very proud of them for getting out there and just taking that opportunity because it's going to pay off in the future.
Absolutely. So that kind of leads into even my own personal story right now. So I'm looking at a property now that was listed 30% below market value. Mm-hmm. And even though it's priced lower, a lot of investors right now are hesitating. It's because they're underwriting the deal or analyzing the deal at like an 80% or a 75% LTV. Meaning, okay, if I put 20% down or I put 25% down, considering the higher interest rate, this property doesn't cash flow. So I'm not going to purchase it. So even though the property is listed lower, it's just sitting on the market because of that. Now, I do know that I can actually increase the rents at the property. So once I purchase a property, I'm probably going to do a little better than break even once I get the rents up, just considering that my interest rate is a little bit higher. Or another option I have is actually put a little bit more money down. Maybe I put 30% down or 35% down just to get my monthly payment reduced, right? To get my debt service reduced. So, I have a property that I negotiated at a much lower price. I got the rents up. Now I'm doing pretty well. Now, the good thing is once interest rates fall, which we know eventually the interest rates will drop again, I can just refinance. So now my monthly payment or my debt service can be reduced. That increases my cash flow, right? And then as interest rates come down to a reasonable point and the market rides back up again, values will rise back up again. So not only will I benefit from the forced equity that I have from making the improvements at the property, I will also benefit from the equity from when the market rides back up again.
I think that's an awesome, way to look at it. And I think everyone kind of has to look at their own personal situation and see what makes sense for them, like we mentioned, and take advantage right now. And as a thank you for staying to the end, we have a bonus tip. So Michelle, go ahead and share.
Yeah, so our bonus tip is taking advantage of assumable loans. Now, assumable loans are a great opportunity for you to still buy properties at a lower interest rate from a loan that was originated earlier. So for example, let's say a person bought a house just 2 years ago and he bought it with an FHA loan. He put 3.5% down and the interest rate was 3.5%. So, definitely lower interest rates than what is out there right now. Well, now the seller needs to move. Maybe he lost his job, or he needs to relocate, or whatever particular reason he needs to sell. So then you as the buyer can actually assume or take over this loan at the existing interest rate of 3.5% down. Now, what you have to do is that you do have to come up with the difference between the purchase price and what the balance of the existing loan is. So for example, just to make numbers simple, let's say the house is $500,000, but the seller has a $400,000 loan at 3.5%. So if you could put $100,000 down, you can take advantage of a loan that's only 3.5% down. Or even to kind of think of it in better terms, let's say someone only put 3.5% down when they purchased it 2 years ago. Well, it was only 2 years ago, so they probably haven't paid down that balance, a whole lot. So maybe they're selling it, and now you as the buyer only have to put 10% down. So if you could put 10% down as an investor and get 3.5% on the interest rate, that could be a good deal. This applies to any government-backed loans typically. FHA, VA, USDA loans, and on the commercial side, Freddie Mac, Fannie Mae, those kinds of Freddie Mac multifamily, those kinds of loans are also assumable as well too.
So after today's conversation, you see that there's many ways and opportunities to take advantage of a shifting market. So if you're looking to get started on your investment journey, or you're looking to buy or sell, be sure to check out our website below, doordiariesre.com, and we'll connect you with a real estate advisor in your area to help you get started. Also, be sure to subscribe below so that you can hear real stories from real investors working on real deals.
Yes. Bye.